Hi, good afternoon. Welcome to Digital Transformation Thursdays. I'm JJ Dicini from the Dicini Law Office, and we're very excited for today's session. Today's session will focus on, we're calling it the future of finance, blockchain, and digital assets. And we're very happy. We have a very a good presentation today with a lot of strong guests, a lot of our guests to talk about this space. So crypto is something that's been around for less than, wait, let me see, I think it was invented in '09. So it's about 11 years old, if not '09, '10. So it's about 10, 11 years old. But what people don't know when they think of crypto or think of digital assets, the first thing that comes to mind, of course, is Bitcoin, which was the first implementation of blockchain. But it's a very simple implementation of that. The value of blockchain actually is in the underlying idea, where you can have a ledger, right, or a file or a truth, so to speak, that can be maintained online by people who are not connected to each other, who do not know each other. And there could be something that is true between them. In this particular case, what is true is who has control over a Bitcoin and who owns, or who has control over a Bitcoin. So if I transfer control to you, I send Bitcoin to your Bitcoin address, the ledger, the blockchain will reflect that. And there's a very significant invention, because it actually allows for decentralized transacting. In other words, prior to this, all electronic money systems were highly centralized. And now blockchain allows those things to be decentralized. And in a sense, it's also about trust, right? So in a decentralized system, you can afford to have less trust because the trust is established by the system itself. So the blockchain allows for that in an ingenious way. And actually, our guests will be discussing that later. So first, to our first presenter, we have attorney Lar Cerso, a senior associate at the firm. She's a graduate of the UP College of Law in 2015, and she heads our FinTech practice. She's also a consultant with the UP Law Center's Technology Law and Policy Programs. She's been cited by the Legal 500 as next generation partner. And she advises a lot of fintechs, IT companies, and startups, and regularly assists clients in BSP licenses applications and compliance projects. So I'd like to call on attorney Lar Cerso to come online and make her presentation.
Hello, good afternoon. Good afternoon, everyone. Let me just share my slide quickly. All right. Okay. Hello, good afternoon. So for my portion, this will be a quick crash course on the regulatory issuances, the law and regulations applicable to the various types of digital assets in the Philippines. So this answers the following question. So if you're an issuer or if you're a company, not just limited to like blockchain empowered entities, but if you're a company that wants to implement, let's say, a new type of payment method, or you want to go cashless, and then the next questions you'd ask yourself would be, what's the applicable regulation for this activity, for the payment implementation that I want to do? What are the licenses or permits required? And which regulator would have jurisdiction over my activity? So unlike certain industries, the regulation for figuring out what type of regulation would apply to your digital asset is not a straightforward manner. So depending on the functionalities that you want to introduce, digital assets could be characterized by a regulator as either a virtual currency, as electronic money, as security, or even as gift checks. And then, of course, this is continually evolving given how given how novel and innovative the subject technology is, there are still draft guidelines being issued by various regulators, particularly or most relevant for this case, the BSP and the Securities and Exchange Commission. So if you're an issuer, you have to be able to identify and enumerate the functionalities that are embedded in your token or in your system. So this table outlines the main types of regulations that would be important. So if you're a virtual currency, you would fall under the BSP. However, the BSP mainly regulates the exchange, where various virtual currencies are exchanged for other types of VCs or for fiat and vice versa. If you're an electronic money, you would still fall under the BSP. And the entity being regulated here would be the issuer, the entity issuing the electronic money. And then if, let's say it's a utility token, it may qualify as a security and therefore fall under the jurisdiction of the SEC. Now, the SEC regulates the security itself. So the token itself must be registered. And then the SEC also regulates the entities that can distribute or offer for sale the subject token, as well as the exchange or platform where the tokens would be traded. Now, if let's say you're merely providing a gift check, given the limitations in the digital assets functionality, then you don't need to get a license. However, you will be governed by the regulations for gift checks provided by the DTI. All right. So just a quick run through the various types of digital assets and how to determine what your digital asset is in terms of determining what regulation would apply. So for virtual currencies, this is a digital unit used as a medium of exchange, created by agreement within the community of VC users. So it's important to note that VCs under the BSP rules are not guaranteed by any jurisdiction and do not have legal tender status. Now, if it does have legal tender status, it may fall under e-money instead. Now, electronic money, it's stored in an instrument or device. So it could be cash cards, it could be in your mobile device, and then issued against a receipt of funds and for not lesser in value than the monetary value issued. And then this is an important part of the definition. The asset or the e-money is accepted as a means of payment by persons or entities other than the issuer. And lastly, the token is withdrawable in cash or cash equivalent. Usually between an e-money or a VC and between an e-money or a gift check, the difference usually lies in the last two requirements here, letter C and D, that the token, the asset, is accepted as a means of payment by entities other than the issuer, and it's withdrawable in cash or cash equivalent. Usually or generally, if the asset doesn't have this two or doesn't meet these two requirements or these two definitions, it could very well fall under the meaning of gift check. Now, to illustrate, let's say you're a retailer or you have a platform and you want to introduce a new cashless way for payments. And then if the token itself, the digital asset that you will issue may only be used by users in your platform, and there won't be any P2P transfers, and the users or the holders of the tokens won't be able to withdraw the store of value. In most cases, that could just be a gift check. However, once you introduce a functionality that would let them withdraw the store of value for cash, for pesos, then you might fall under e-money. Okay. Now, let's go to gift checks. So as I said, a gift check is any instrument honored upon presentation at a single merchant or an affiliate group of merchants as payment for consumer goods or services. So it may be in the form of paper, card, code, or any other device. So now, in the example I stated, it's important to know what functionality would trigger what regulation, just so that you're aware whether your activity is already stepping into an area of the regulations wherein you'd have to get a license with the BSP or maybe the SEC if your token would have any characteristic that would render it as a security. So the obvious examples for gift checks would be, let's say, a coffee shop that allows you to purchase gift cards or allows you to load up your mobile gift card so that you can use that store value for payment only in their participating stores or branches. Now, in that case, that's a gift card. Now, if let's say the coffee shop suddenly introduces a functionality that would let you withdraw your store of value for cash, now they may be considered as EMI. Now, for securities, securities are any token or digital asset that would represent shares or participations or interest in a corporation or a commercial enterprise or some profit-making venture. It's evidenced by a certificate or contract or any other instrument, whether written or electronic in character. Now, as I said, the digital asset that you would be issuing or you would be trading could start out as one thing, but once it undergoes certain developments or you change its functionalities and its purposes, then you might cross over to another regulatory area. So now another relevant regulation would be the regulations issued by the CEZA, Cagayan Economic Zone Authority, which regulates virtual currency exchanges in the zone or in CEZA alone. So this is relevant for virtual currency exchanges or any entity, usually foreign, that would want to be regulated by a government authority. They can go to CEZA and apply for a license there. However, it must be noted that for an applicant to be qualified under the CEZA rules and thus operate in the zone, its target market or its users must purely be users offshore. So CEZA-based entities can't target Filipinos. Once they do that, then the previous regulations which we've discussed would apply. All right, now, so moving forward, there are various regulations being drafted right now, as mentioned. However, two of the most relevant ones would be the SEC rules on ICOs, on initial coin offerings, and the BSP's draft rules for virtual assets and virtual asset providers. Now, for the SEC rules on ICO, it basically provides the procedure which must be followed by token issuers before they issue the tokens to the public. So the SEC, based on the draft, they want all issuers to submit for an initial assessment with the SEC, submit their proposed tokens, submit their white papers. And then based on that, the SEC will do an initial assessment and review whether the token is a security token or not. If it does determine that it's a security, then the token must be registered with the SEC as per its securities rules. Now, aside from that, since what's being contemplated here is a digital token, the SEC also requires that they conduct an ocular inspection as well as a system walkthrough. Now, again, this is just a draft. It hasn't been approved yet. Now, for the BSP, it issued its draft guidelines for virtual asset providers. And then based on the guidelines, the regulator basically broadened the scope of what could constitute as a virtual asset. And it also broadens the scope of entities which the BSP regulates. Now, it's important to note that under the existing regulations for virtual currencies, the BSP only regulates the exchange itself. So it doesn't regulate the issuer or the other service providers whose services are necessary in order for the exchange to happen. However, under the draft guidelines, the BSP now regulates the entities involved in the exchange of the virtual assets, as well as those which conduct the safekeeping and or administration of the virtual assets and instruments, as well as service providers that provide just the technology that would make the exchange possible. So that's basically where we are in terms of the regulatory landscape for digital assets. Now, I believe the next two speakers would do a more in-depth dive into the existing regulations for blockchain, as well as the operations, or what happens when what you refer to when you say blockchain implementation, etc. Right now, I'll pass it on to Attorney JJ.
All right, thank you, Lars. Let's see. Okay. Yes. So
I have
okay.
to stop.
You have to stop. Yeah, I have to stop sharing. All right. Thank you. So our next speaker comes from the Securities and Exchange Commission. Securities and Exchange Commission. He is the Honorable Efiro Luis Amatong. He is one of the commissioners at the Securities and Exchange Commission. He is a graduate of the University of the Philippines, BS Economics, and also earned his law degree from the UP College of Law. He pursued Master of Studies at the Harvard Law School, finishing with a degree of LLM in International Finance. He served for a while as Assistant Secretary at the Department of Finance prior to being appointed to the Securities and Exchange Commission. As Assistant Secretary, he was also the Vice President of the Philippine Deposit Insurance Corporation, and previously also was a Corporate Staff Officer at the National Power Corporation. And then I guess earlier in the career, he was a Supreme Court attorney. The truth is that actually Commissioner Amatong could not be here. So what we did instead was we recorded his session. So actually, to his credit, we recorded this on a Sunday. So I'm going to share that with you now. All right.
So I'd like to thank you for inviting us to be part of your Digital Transformation Thursdays. The truth is, and I'll get to that in a bit, we actually do want to reach out to the FinTech community, and we've been trying to do that. And we also want to reach out to the legal community that's knowledgeable about FinTech. And that's not a particularly large community, because we think this really has to be done in coordination and cooperation with the private sector. As you'll see, hopefully through this presentation, the SEC is still trying to develop its own sandbox approach to analyzing FinTech. In principle, we have adopted the sandbox approach, and we have a view of, we have a desire to apply the sandbox approach in order to test new technologies. But in practice, translating that into an actual framework for vetting a FinTech is a separate matter. So we know what we want to do in principle, but being able to do it is another thing. So we thank you for the opportunity to speak to you and the community behind FinTech. Now, you posed a very good question to me. I don't know if you want to do it now, so you can do it in your own words, but I thought it was a really good way to start this off.
All right. So the question that I posed to you was, I think increasingly, if we're looking at what do you call this? We're looking at the future. The future looks like it's going to involve digital assets, which were designed specifically to remove as many intermediaries as possible. And I think the question now is, the SEC, I think the history of the Securities and Exchange Commission is precisely in regulating those intermediaries. I think prior to that, the stock market was unregulated. I think famously after that, was it Papa Joe Kennedy, I think, was the first Securities and Exchange Commission. And I think I believe there was it Roosevelt or somebody had said, yeah, he knows all of the tricks. So he should be the one. He knows how to regulate this market. And my understanding of the way SEC regulates is that it regulates it by licensing the intermediaries.
Right.
And there are many, the brokers, the broker-dealers, and the exchanges, and also the issuers of the securities.
Right.
So in a world where increasingly that will be disrupted, what role do you think the Securities and Exchange Commission will have?
Yeah, I think that's a great question. Partly because, well, let me first start with our standard disclaimer in our presentations, which is like for purposes of this webinar, these will be my own personal views and not necessarily those of the commission as a whole or our staff as a whole. And that really allows me to speak more freely with you and your audience about what we think and our approach, or at least my view of what our approach should be towards this fintech and this disintermediation trend that you've pointed out, which is a correct point of view, I believe. And really, our basic approach to fintech is what I've put out now on our slide, which is that the technology may change, but the concerns that we're trying to address through regulation doesn't really change. The approach by which those concerns are addressed may change because of the technology. And in fact, as you pointed out, when the US SEC was first created, 33-34, and when the Philippine SEC was created just very shortly after the US SEC, since then, from then until now, there have been actually technological changes which have affected the way we regulate. But the underlying concerns, which I put out here, transparency, disclosure, fairness in dealing with investors, suitability of investment to the investors, fiduciary responsibility of people who are entrusted with investor money, and the more modern concerns like anti-money laundering and know your customer. These concerns have not changed. So our approach is like, okay, the fintech it promises a new way to address persisting concerns. That's our approach. And in fact, if you think about it, fintech has already done that. Even before it was called fintech, technology has already affected the way we regulate. In 33 and 34, everything was paper-based. So really, a share of stock was on a piece of paper that evidenced your ownership in a corporation or a bond or a certificate of indebtedness or some other promissory note would be on a piece of paper, and that would evidence indebtedness. And you had one of our key concerns in securities regulations to make sure that payment and transfer of ownership of these securities happen at the same time. The technical term is delivery versus payment occurs at the same time. In Filipino, we have the perfect term. It's called kaliwaan. When I pay you my money, I get my proof of investment in your company, whether it is a bond or debt, evidence of indebtedness, or a share of stock. And once upon a time, that was all paper. And in the 90s and 2000s, we moved from paper to dematerialized securities. So even today, we didn't call it fintech, but no security is in paper format anymore. Everything is lodged in a centralized database that is in the Central Securities Depository. And that facilitates faster trading and faster delivery versus payment or kaliwaan. Now we can, on the bond exchange, within 1 day, effect kaliwaan of payment. And on the equity exchange, the convention is 3 days later magkakaroon ng kaliwaan. Although technologically you can actually be faster now, but we still use the convention of 3 days, and that's very different from when everything was paper and you had to mail your certificate of your security to the other party, and the broker would have to wait for it. The broker would get your check, and the check would clear in the bank, but the broker would wait for that and it got the piece of paper in evidencing the security. So all of that has already changed. FinTech that's coming up, and you're highlighting this in your webinar, promises to revolutionize further some of these mechanisms by not having a centralized ledger or record, or in current terms, a centralized securities depository, but possibly a distributed ledger where the safety and security of the recording is no longer necessarily based on the systems of a particular intermediary, as you pointed out, which is the Central Securities Depository, as the repository of all securities, and the transactions are on the trading engine. But the blockchain itself, distributed among a group of users, has the record, and then you have a distributed ledger instead of a centralized ledger. So that's among the FinTech that's coming up. So that's a long way of saying SEC very open to FinTech, because we think FinTech has enhanced, like in the case of the use of a Central Securities Depository and delivery versus payment mechanisms, it has enhanced and improved securities concerns coming from the paper-based system to the electronic system. And there's the possibility that new FinTech will further enhance and further make efficient securities transactions and securities regulation. So our approach is really, okay, each new FinTech, we have to try to figure out how it fits in the overall scheme of things. So there's no one-size-fits-all approach to FinTech. And we will admit that we're really coming off from our understanding of traditional structure. So part of the challenge to the SEC is the rules were really written when everything was on paper. And it's easier to imagine how the rules will operate in a paper-based world. But having said that, we're really not in a paper-based world today. So even today, we've moved to electronic, and that makes things a little more difficult, particularly for the legal community, to imagine how these transactions are taking place. But our understanding of the traditional method informs the way that we evaluate the FinTech, because that's where we're coming from. And then there was a concern, I think you also brought that out before, that part of the goal of disintermediation, so we're not against disintermediation, particularly if it improves efficiency and protects investors by removing some of the risks inherent in the current system, where you can think of an intermediary as a middleman. Bibigay mo muna yung pera mo to the middleman, or your property or your security sa middleman. And so there is a risk that something may go wrong while it's in the hands of the middleman. No. So to the extent that FinTechs reduce that risk, we're very open. But there was a perception early on that maybe FinTech will render regulation obsolete, no, or like take it out of the ambit of regulation. And our view is that's not really going to happen, because even though the way you do something is different, the essential nature of the transaction has not changed. So our approach to regulation is not really entity-based. No? Just because, let's say, you replace the stock exchange system and having a group of brokers acting as an intermediary with a platform where the program acts as the intermediary to match the investors with the investees, the borrowers with the lenders, the companies, investors. Just because you change the matching system from a group of entities and companies and people to a system doesn't really change the activity. You're still trying to match investors and companies, borrowers and lenders. So from an activity approach, the activity hasn't changed. The underlying essence of the activity hasn't changed, but the mechanics may have changed. So that's why we think, you know, we will continue to retain our jurisdiction, even as fintechs alter the way we do trading and, let's say, disclosure about securities. But they might do it in different ways, and it may change. It may change the entities that are part of that transaction. But we're open to that. We're open to that, and we don't. And evaluating these technologies, you know, we don't particularly favor any. We try to be as neutral as possible because you can never tell. You know, one of the ongoing debates, for example, that we know is going on in the financial industry and the IT industry is a distributed ledger really superior and more efficient to a centralized database? That's one of the questions that's being raised right now, debated on. You know, is the current messaging system for interbank instructions, which is usually done through the SWIFT mechanism, is that necessarily more expensive or less effective than a distributed ledger tokenized mechanism of sending messages? So we don't take a particular side. We try to find out, okay, looking at the technology, does it address our concerns? Does it protect investors? Is the transaction properly recorded? Does it facilitate information exchange and disclosure? Is there central trade reporting? Can we audit the transaction to make sure no one has taken advantage of anyone? Then if the technology, whether present or future, does that, in theory, we should be okay. We should be okay. Okay, so our challenge is then balancing this new technology and the opportunities of the new technology with the current system. Now, naturally, we are more familiar with the current system. So as I said, you know, we're in principle, we're technology agnostic. But the reality is we're kind of aware, you know, we're more familiar with the current system. That doesn't mean we prefer the current system because we know the current system has its own flaws. No? Yun nga, dadaan ka pa sa third party. What if the third party or intermediary or middleman, what if something goes wrong with his records? Diba? But we know this system because it's the system that we have today. But we also know that this system, the current system, could be improved. Now, whenever a fintech comes over and promises improvements, of course, we're interested. No? But then we are also duty-bound to check, wait, does the improvement carry with it other concerns? You know, like on a distributed ledger and blockchain, for example, I'm sure you've heard it, and like, again, I don't pretend to be an IT expert. There are issues about scalability. And what that really means for us as a regulator is, okay, wait, this is good for like a situation where you have maybe 5 transactions a minute and maybe 100 transactions a day. But let's say you have a system that's going with thousands of transactions in a day, with hundreds of transactions. Can the distributed ledger keep up, and will it slow down and cause a backing up or performance of trading transactions? Can it take the load? And that's a concern. Again, that's a technology agnostic concern, because we've seen current systems slow down when there's huge demand, transactions demand. So you try to check as well when you look at a new fintech proposal. Wait, are there cybersecurity issues? My joke used to be, because the SEC itself is going on into its own IT transformation, where we're moving our records. We're still in the process of digitizing our records. And then my joke used to be, well, in terms of cybersecurity, the old system was super cyber secure because it was all paper. And being all paper, it was unhackable. But then since it was all paper, it's so difficult to retrieve useful information from our database. So when you go to a digital form or a different IT form, the question becomes, wait, now I am hackable because it's all digital. Can it be altered? Then what do I have to do to protect myself from the new risks that I didn't have with the old system? So this is again, overall, what we try to do with FinTech. And in terms of distributed ledger technology, we're not the only ones who are interested. So there is actually a working group and the Insurance Commission trying to understand, okay, how will distributed ledger technology, which is, I think, the new neutral term, because before, if you said blockchain, everybody said Bitcoin, and then that seemed to narrow the application. Like, okay, Bitcoin is just a use case or example of how to use distributed ledger technology, but there are other ways to use it. And for example, the BSD, I think, is a leader in the sense that they've already allowed tokenized transmission of currencies or payments through money service entities, so licensed, essentially money changers, and remittance businesses. So that's something they're working on. What we're looking at is the possibility of distributed ledger technology affecting securities transactions. So you'll see at the bottom of this slide, we think DLT is the technology trend that may underpin a number of new trends, and the use case that might be most pertinent to the SEC would be security tokens. We wouldn't be interested in utility tokens, where the tokens are being used to effect some kind of other transaction or record keeping or payment, but security tokens, where the tokens evidence either an indebtedness or an equity investment in something, a loan, some kind of investment contract, asset-backed, a token that represents some kind of financial asset. Those things are probably the ones that the SEC will be most concerned about, and for that, we're thinking about how they could contribute to what we think of as a digital asset exchange. Now, this slide just again tries to illustrate our approach, which is like, this is the traditional structure. So if you look at this slide, there's an investor, there's a buying investor, there's a selling investor, let's say on an equity market, and then there are these intermediaries that you see in the middle. Each one speaks to a separate broker. They deal with an exchange within the middleman, within the middle. And aside from the exchange, there are other intermediaries, like a settlement bank for the cash side of the transaction, and then the depository for the security side of the transaction. So again, our concern usually is to make sure that when the trade is effected, it's done on a first come first served basis. So walang unahan, diba? If I'm the first, if someone's offering for sale a security at 100 and I raise my hand first digitally, I should be matched with that transaction first. And then magkakaroon nga ng kaliwaan currently through these entities. Now, the promise of FinTech is, okay, maybe we can eliminate some of these entities. Now, these intermediaries perform certain functions. For example, the settlement bank is the one that handles the flow of payment or the money, and then the depository is the one that maintains the record of securities, and the clearing agency is the one that ensures delivery versus payment or kaliwaan. Now, maybe a platform can combine some of these entities. Maybe a platform can remove the need for separate brokerages. The platform itself, through its own algorithms and programs, are the ones that matches the investor, the buying investor to the selling investor. Okay, so but when we get a proposal, and so on the right hand side you'll see, and I'll discuss a little bit more, a certain use case like for record keeping. We think of the traditional structure, but then we think, okay, what portions, what functions of the traditional structure will now be performed by the fintech? How does the fintech ensure that the risks are no worse or not much more than the current system, and how does it ensure that it doesn't add more risks that are unacceptable or risks that are not controlled in the system? So again, this is all like a very theoretical approach, but the reality is we've actually now moved along. Now we have crowdfunding rules that have already been finalized, and we have prototype rules for digital asset offerings and digital asset exchanges, which really go together. So that these are the alternatives to issuing a security. So now you issue a digital asset instead of a security. And then you, instead of trading in a traditional exchange, trading through a digital asset exchange. Those two other rules are still in the development stage, but we're nearing the end. But we've used, and I'm happy that PDAX is your other guest for this webinar, because they've been involved in an actual system that we have supported, that was and I'll talk about that in a little while, that was really triggered by the Bureau of Treasury, where their system and their online app was part of the mechanism for the distribution of the recently completed retail treasury bonds. We also, as I mentioned, our crowdfunding rules have gone out, and we are very close to approving the first crowdfunding fintech in the Philippines, which will be some kind of debt market matching fintech, or something like Lending Tree in the United States, where it's a peer-to-peer lending platform. Okay. So I think the case of bonds.ph, which was an app. I think most people know it. Most people know of it more as an app. That was really something that was done by Union Bank in cooperation with PDAX. Is an example of a use case where fintech can address a concern with the current system, and we're trying to do it in bits, right? So in the case of bonds.ph, the concern with the current system is when you subscribe to, or you try to buy into a retail treasury bond of the BTR, normally you have to go to one of the banks, and then you have to go to your branch and apply and fill out a paper form and do your KYC, and it has to be transmitted. So it's a very paper-based system and a very face-to-face transaction system. So you have to go to the branch to apply. You have to go to the branch of one of the banks that is a government securities eligible dealer. And you can see already that during a time of COVID pandemic, where various parts of the country are on various levels of quarantine, and really, who wants to go to physically go to a bank and sit down for 2 hours to fill up a paper form? This paper-based mechanism of onboarding, or going through the know your customer process, identifying yourself as a subscriber for a retail treasury bond, and filling up the form essentially to make order of the retail treasury bond. The current system is not the best, obviously, especially in a COVID-19 world. So the question then came, okay, could you do it via an app? Could we reach more people? And for example, there's so many people who are unbanked, so many people who have money to invest, but especially if you're in the provinces, I'm actually a provinciano myself. If people, I come from Zamboanga del Norte, if you want to go to the banks, you have to go to the capital city of Dipolog. In order, what if you're a trader coming from one of our southern towns of Liloy or Sindangan, or one of our northern towns like the twin city of Dapitan, but the Land Bank branch, for example, or the Metro Bank, or even the Union Bank branch is in Dipolog. So you have to go all the way to Dipolog, go into this. So the idea here is, like, why don't we just do it on an app? Why don't we just do it on an app? So Union Bank made use of the PDAX technology in order to take the subscription onboarding KYC process and make it digital and use an online app. And this was something that was supported by the Bureau of Treasury. And the question then became, would that be a permissible way for Union Bank to distribute an RTB? Okay. So our approach, we tried to put into practice the approach that I tried to outline earlier. Okay. So in this case, Union Bank, making use of a distributed ledger technology, which I think PDAX can discuss better than me, and an online app in order to obtain customer information, know your customer information, and the order information from the various customers, and also inform the customers that yes, success po your so the app does know your customer, takes the order, you can put money in through the app, and the app informs you if yes, now there are retail treasury bonds lodged in the central record of the treasury in your name. So we're just using the app as a means of transacting with the investors. And when we analyze the process, and this is kind of like the rough idea of the process, okay, Union does not do anything more than it's already allowed to do or licensed to do. It just does it in a different way. Instead of issuing paper forms and taking the orders through the branches, they go through an app that they vetted, right? And we vetted, and they are entirely responsible for the outcome of the app. So from our point of view, there's no increased liability or increased risk. Everything is still the same. All responsibility is still borne by Union. As far as the investor is concerned, he's transacting with Union Bank just as he would if he walked into a branch, except that he's doing it now through the use of new mobile technology. So we said go, and I think it's better for PDAX to discuss how the details of how it went, but generally I can say BTR is very happy. They've reached more people, more Filipinos in more countries than they ever did before with their attempts at retail distribution. And they're seriously considering using the same platform or a similar platform again going forward. And we think we're still doing our post audit of the order taking through the Banks.ph app, but so far looks like it performed the way it was designed to perform. The question now becomes, okay, can we scale it up? Can we get even more orders through this mechanism? And I think this kind of illustrates an application of the framework that I tried to outline earlier on a more concrete level. Now, part of the challenge here really is, again, we want to go incremental. So this was very, Union and PDAX were very cooperative in our request that they go on an incremental level. Instead of immediately disintermediating all of the banks, all of the mechanisms in the traditional system, they just concentrated on one area first. And so it's easier for us to say yes, easier for us to audit. And if the experience is successful, which it seems to be, then even we become more aggressive and, okay, let's see what else we can do. And I think this is the beginning of a concrete application by the SEC of this sandbox approach. Like, let's test it in this area first. All the other elements of a retail treasury bond issuance is the same. So the record keeping is still within Treasury. There are still custodian banks that hold the securities for the investors. But let's test this area first. And as we become more confident with the technology, then we become more open to additional use cases of the technology. So that's one very concrete area where I think we've made progress on really implementing FinTech. And the other one that we're hoping to do soon, so I can't really say for sure yet, because it still needs to be brought up to the Commission for approval, is crowdfunding. And I think most people, I think, have some rough idea of crowdfunding. People have heard of Patreon or GoFundMe in the States. But in the Philippines, we don't intend to regulate. So again, activities-based. Just because it says crowdfunding doesn't necessarily mean that the SEC has to regulate it. If the crowdfunding is really a way to obtain or source donations, may drive, for example, for COVID response, or Red Cross has some drive and they want to use an app, that's donation. We don't regulate that. Okay. If crowdfunding is really, you're looking to solicit, let's say, for example, patrons to support you in your production of artwork or music. I think many of us will have seen that artists who cannot perform concerts now are doing it online, and then they receive voluntary payments through Patreon or similar. That's not us. That's an investment. What we do is on the right side of the slide, which is if the crowdfunding is to match borrowers and lenders, or if the crowdfunding is to get investors, okay, however you want to call them, whether they're stockholders or they're not stockholders, supporters, whatever, but they're promised a return. If you're promising a return on your investment, so soli ko po yung pera, tapos kikita ka pa. Okay, whether that's a promise like a debt, or it's a more equity-based na, okay, kung magiging okay yung negosyo ko, hahatian kita dun sa kita. Okay, so that's may hati sa kita, equity-based crowdfunding, then the SEC will have to come in because that's within our jurisdiction. So that's how we think of crowdfunding. Again, it's activity-based. Does the activity fall under investment? And the thing that we're looking at now that is nearing completion again, and I want to talk about it in depth because we haven't got to it. Is this peer-to-peer lending app called Investry Philippines, where they're trying to facilitate through an electronic platform funding through debt-based funding. And we're particularly interested because they're targeting MSMEs. And again, in this time of COVID, where we anticipate it will get harder for medium, small, and micro enterprises to obtain financing through a loan from a bank. This might be a way to facilitate funding of MSMEs. But we do have to vet very carefully to make sure that people know the risks that they're taking, or at least the risks that people take are limited and mitigated when they go to this platform. Pag nagpapautang po tayo, we're not always sure na masasoli sa atin yung pera with interest. So there we take an investment risk, and we just want to make sure that people are aware and are able to mitigate their risk. But we also see the potential, lalo na ngayon, na it's hard to go to the bank, make an application, fill up a form. Maybe this is a mechanism where people who have some savings can support other people who are transitioning from one work, marami tayo ngayon na work from or starting up a home. Many in our neighborhoods biglang naging bakers, diba, or gumagawa ng pagkain masarap magluto, diba, and are supplementing their income. Maybe this can be a mechanism. But again, we just want to make sure that people are protected as much as we can protect them, or at least they are aware of the risk. And we're hoping to see the launch or to have this implemented sooner rather than later. There are some other areas that we're looking at. These are more technical sounding, but real. In fact, I had a question from an investment bank a few days ago about direct market access, and this is essentially, what if we cut out the underwriter? You know, what if somebody just listed on the stock exchange and then direction now using an app? And this has been done in other countries. No? What if we solicit the investments through the online platform, going beyond bonds.ph na may banko pang intermediary? No? Now, what if we remove the intermediary and go for a direct listing? So that's something that we will have to think about very carefully. Again, the idea is to make sure that it's not unduly more risky than the current system, but it in theory makes things easier for people who starting a business to raise money without having to pay the fees of the underwriter, the account, well, maybe the accountant they still have to pay, and of course the lawyer. so maybe it can make those costs lower. And then the other thing that we've already actually started to do is simplified KYC for low risk accounts. So making the onboarding process as easy as the payment apps that people have gotten used to during this quarantine period and pandemic. I think the observation has been that a lot of people have now become users of electronic payment systems like PayMaya or GCash or others, and the onboarding process so if you can go on those systems and order a coffee or pay for groceries or maybe you can also make an investment through those systems, and we shouldn't make the KYC process any harder than it is for setting up for low risk accounts. So that's those are other areas that we're actively working on, and that kind of like, I hope that kind of illustrates that we are trying to walk the talk in terms of not just saying that, you know, we welcome fintech. We're trying to actually make fintech work for the investors and for the general public, but also still acting as a regulator, mitigate the risk and protect the people in the system. Hopefully this was informative. And then JJ, if you have any questions, I know unfortunately I can't be there live for the webinar on Thursday, but if you have any questions, I'd be happy to take them.
Well, first of all, I'd like to thank you for making that great presentation and talking about the perspective of the commission, which is really I think it's the correct approach that you're taking. There's a lot of things that are going on right now, just in the last 6 months because of the lockdown, because of I think it's driven by the pandemic. So there are a lot of what's called distributed finance projects that are coming on board. And the more I look at it, I mean, the idea I think of distributed ledger was, you can have a transaction, what you call a trustless transaction. But the more I look at it, I think it's not true. I think what happens, in fact, if you and I were trading Bitcoins, and I don't know who you are, you don't know who I am, theoretically that transaction will not happen until you can find a way. If you were selling me Bitcoins, until you can find a secure way for me to transfer value to you, you won't sell me your Bitcoin. So even in the old days, as it were, maybe we're talking about 3-4 years ago, right? There would be these escrow services, right? Where they will take your money, they will take your Bitcoin, and once the money arrives, then ang nagkakaliwaan is the intermediary. And then now there are all these things where it's now smart contracts, right? So smart contract will do that because money is now digitized, etc. But now the smart contract is your intermediary. And really, when you think about it, the intermediary is the software coder who wrote the smart contract. Right? So there's this thing now emerging called smart contract insurance. Right. So if it turns out that the smart contract has a bug, you get paid by insurance. So the more parang you dig into this thing, the deeper you go into it, it's a rabbit hole because they're innovating faster, I think, than the SEC can follow. But at the end, I think your approach is correct. In the end, you have to look at the analogy and say, okay, who's the intermediary here, right? Because in the end, right, that's the guy we need to regulate. Because in the end, that's the guy everybody has to trust.
Yeah.
Right?
So
platform provider. Yeah. Go ahead.
That was an excellent. I think that you provide an excellent example of the challenges that we're trying to address and the whole problems of fintech. So just that example, in the olden days, which is so funny, which was like 2 years ago.
Right. Yeah.
You'll notice that the issue there is how to effect kaliwaan, or what we call delivery versus payment. And,
yes.
And DLT for Bitcoin only solves the problem for one leg, which is the security. Right. The chain covers the record keeping for the security. But if you noticed in my slide a while ago, so that the agency needs to make sure that the money leg, which is done through the settlement path, there's at the same time as what you want is a change of record of the money simultaneous with the change of record in your example of Bitcoin or any other digital asset. So the essential problem is how to make sure kaliwaan yan
correct
remains,
because there are people who won't perform.
Right, because DLT for Bitcoin in particular just solves one leg, just the record, but you have to wait for the other leg, for the cash leg. Now, could you have a digital clearing agency wherein a programmed smart contract when an order is placed and money is made available, does the matching of the cash leg and the security leg or asset leg at the same time? I mean, that's what you're implying with the smart contract. But then the challenge to the regulator was, does the program work the way it's intended to work? Because we also know from technology that many times you go through multiple iterations of a technology before it's really reliable. No matter how well you alpha test it and beta test it, in the initial run there will be problems that you did not foresee. So that becomes, so it's not that no, we don't think of that possibility, because automated clearing, and again, this is something that if you think about it, this is something that the BSP has acted on very recently with these digital payments. And I hope many people are experiencing already that many times you can clear a check now, just taking a picture of it and clearing the picture. Until a few years ago, 3-4 years ago, we were still clearing checks with magnetic ink, which was a 1950s technology. And then we why do we do that? You know, you don't need, the check had to physically, really go through a machine that would separate the checks to different banks based on the magnetic ink code, kind of like a barcode on the check.
The maker.
You don't need to do that anymore. Yeah, but it can be done. It can be done. Now, it takes a while because you're so comfortable with your 1950s magnetic ink. But, particularly when there's for it and demand, like today's COVID pandemic, and the need to be less face-to-face and the need to transact more digitally, I think that's a driver for change.
All right. Thank you. Thank you, sir.
Okay, so
Hello, everyone.
Hi, I'm sorry.
Okay,
I stopped the sharing earlier than I should have. Anyway, di nyo na nakita yung the last part of Commissioner Amatong said thank you for the opportunity, and I thank him as well. As you can see from the regulator standpoint, there's a lot of they know what they're doing, right? They understand, they're studying, and they're going at it in a very thoughtful way. I wanted to just before we go to our next guest, who is Nichelle Gaba of PDAX. I just wanted to do a shout out to the people who are here, and we asked you where you were from, and I think we have people from Luzon, Visayas, Mindanao. So we have people from Batak, Ilocos Norte, Benguet, Abra. Attorney Lars Sersa is actually coming in from Kalinga, Tabuk. We have people from La Union, we have somebody from Nueva Ecija, Quezon City, Mandaluyong, Makati, Las Piñas, Bacoor, Cavite, even someone from Las Pate. And then we have people from Iloilo, Bacolod, and Zamboanga. So I think we've got we got Mindanao also. And also we have someone from India, and someone from Dubai, and someone from Saudi Arabia. So welcome. Somebody from Baguio, they're still posting. Welcome. We're happy that you're here. It's just fantastic, right? This is pre-COVID. You could never imagine that people from so far away would come together in a common sort of learning process. We're very happy to have had this opportunity to share this with you. So moving on to our next speaker, who is Nichelle Gaba, who's founder and CEO of Philippine Digital Asset Exchange, or PDAX. He's a graduate of the Ateneo de Manila University with a degree of management engineering, with an MBA that he earned from, took his MBA from the Wharton School at UPenn, focusing on finance and real estate. He was previously investment banking associate at Evercore, and worked also at Macquarie Capital. And in the more recent past, worked at HSBC for 6 years, ending his term there as Vice President for the Trust Department. He also teaches at Ateneo de Manila and is a chartered financial analyst. What is that? Sorry. Analyst. Okay. So let's have Michelle. Okay.
Hi.
Go ahead.
Thank you for the introduction, JJ, and thank you for having us here. Can you hear me okay? Quick sound check.
Yeah. Good, good.
Okay, perfect. Well, I'm very excited to talk about distributed ledger technology and its applications in the financial services industry. And I prepared a pretty simple presentation about. Initially, I'll start by sharing a bit about what distributed ledger technology is, what it actually does, and then I'll discuss a little bit about how we're applying distributed ledger technology in both the payment space and the securities space. And later on, I'll touch a bit more about decentralized finance and the other applications that we could expect to see in the market. Okay, so first, what is distributed ledger technology, or what's blockchain technology? I think the best way to describe it really is to compare it with the existing way that we were familiar with, with regards to computing. Obviously, there's in any application you have the client, which is the phone or the computer that runs an application. All the computation is done via a server, and all the records are kept in a centralized database accessed by the server. Now, we've always been able to work with this okay when we're just transmitting information, right? We're writing a Word document or sending emails to one another. But this model fails when we try to transmit value, right? Because if I have a digital 1,000 pesos that I'm sending to somebody like JJ, actually the one who controls the database can counterfeit more of that 1,000 pesos, right? So that's what's called the double spend problem. And Bitcoin was actually the first successful product that solves the double spend problem. And it's done through distributed ledger technology. So how does it work? Well, rather than having a centralized database or server, you rely on multiple servers or multiple databases everywhere, right? Distributed. Now, sometimes they're called nodes, validators. For the sake of consistency and efficiency, I'm just going to call them nodes. Now, each of these nodes, I'll speak more about the case of Bitcoin. Each of these nodes keep a copy of the Bitcoin ledger. Now, if I want to send 5 Bitcoins to somebody else, what happens is the Bitcoin protocol enforces validation rules, or what's called the proof of work mechanism, to establish truth or to establish consensus among all these nodes. So if I send 5 Bitcoins to somebody, members or nodes in the network will validate the transaction. And if it's valid, it synchronizes that transaction with everything on the ledger, like with every node on the network. Now, that's the reason why it's deemed to be secure, right? Because it's very difficult, if not impossible, to compromise all of these nodes at the same time. And it's also very difficult to replicate the computing power necessary to take over all of these nodes. Now, Bitcoin was the first application of that. And what's interesting is the model of relying on centralized ledgers or centralized databases is not unique to software applications. In fact, our payments landscape or our payments infrastructure globally relies on centralized parties as well. So let me just show you how it looks now. So here, you see here yung centralized payments. Now, if you have a bank account, the bank is in charge of maintaining a ledger with your deposit balance on it. Now, that bank then maintains a deposit balance with something like a central bank. Okay? So like a BSP DDA or demand deposit account. Now, it has been very efficient for us, reasonably efficient for us to transact through the banking system, because Bank A will just reconcile its records with Bank B and will then reconcile their records with the central bank. And as long as all the records reconcile and match, we as consumers don't see the problem. Now, but since we now have the technology to not require these intermediaries in the payment space, we're starting to realize the efficiencies that can be had with a decentralized payment system. Maganda yung sinabi kanina ni Commissioner F that in many ways, we also have to ask if the efficiencies gained are actually worth it. Because in many cases, they're not, right? In the case of payments, there are pockets of efficiencies that can really allow democratized access to financial services if we have more of these DLT-based payment systems. I'll give a few examples now of certain challenges that we face in the traditional payments infrastructure. The first is the cost of working capital. Now, you see all the banks here, right? All the banks, all these parties that facilitate payment to one another as part of the payments network, they have to maintain working capital with their counterparties, and they have to maintain working capital, and that working capital has cost to it, right? So at any given time, maybe X million or X billion pesos reside idle, only to facilitate payment transactions. Another pain point that I think as Filipinos we're quite familiar with is that the cost of remittances are pretty high. For a currency like the Philippine peso that doesn't trade directly with some of the major currencies, everything goes through the US dollar. So in effect, if somebody is from Saudi and wants to send money to the Philippines, there will be two FX transactions there, from Saudi Real to the US dollar, and then from the US dollar back to Philippine peso. And because we're going through two FX markets, we're suffering FX spreads twice, and we're also paying remittance fees twice. So there's been various studies conducted on this that indicate that the average cost of remittance for our OFWs is between 7 and 8%, which is staggering because at 8%, if they work for 12 months at a company, for 1 month of that, they're just working for the remittance transaction. So it's pretty staggering. But how can decentralized or distributed ledger technology-based payments solve that? Well, with my explanation earlier on Bitcoin, we're actually dealing not with human or person intermediaries here. We're dealing with nodes who are part of the Bitcoin network. And as part of the Bitcoin network, all these nodes run the same protocol. That protocol is open source. It's been reviewed over the past 10 years and found to be robust. And so there's now a lot of trust in the Bitcoin ledger. But it's not a cure-all, right? So Bitcoin itself can be very slow. And there's also limits to how many Bitcoins can ever exist. And it also suffers from the problem of, in some respects, it suffers from the problem of being scarce, right? Because as a scarce instrument, the tendency is for Bitcoin to appreciate in value over time. And so people would rather hold it than spend it. But that aside, in this payments infrastructure, what's happening is if I am sending money to somebody from my Bitcoin wallet to somebody else's Bitcoin wallet, there's no central party in between that can either corrupt the database or that can stop the payment or that can otherwise charge fees outside of what the Bitcoin network will take as mining fees. So in a lot of ways, it makes payments more efficient and much cheaper. Now that's Bitcoin, and I'm sure a lot of you already have some background on Bitcoin and blockchain technology. So I'm gonna stop the technological portion of DLT there, and I'll discuss now applications. Uh, Now, aside from Bitcoin, I guess this is if Bitcoin is if Bitcoin was the first application of blockchain technology, then Ether was probably been the most impactful. Okay, what is Ethereum? Okay, uh, Bitcoin, even though it was in itself a technological marvel, it was also painfully limited. The only thing that the Bitcoin ledger can do is keep track of how many Bitcoins a particular wallet holds. That itself is not very useful um, for other applications. Now, Ethereum is a platform that uh, allows developers, allows entrepreneurs to create services using distributed ledger technology. Uh, so in today you hear a lot about smart contracts. What are smart contracts? Think of smart contracts as programs on the Ethereum platform that run without any more triggering from the authors of that contract, right? I think in the maybe in the legal community, when we sign contracts, sometimes the principals don't fulfill the transactions, right? Or sometimes, in order to ensure fulfillment, we rely on intermediaries like trustees or nominees or agents to verify and actually remove the risk of execution. In the world of Ethereum, that is taken that part is handled already by the smart contracts. That's why there are applications or there are use cases that are a good fit for smart contracts. So one example, and I think Commissioner F kind of touched on a bit earlier, is if you have if for example you trade a security in the market and you want to ensure DVP or kaliwaan, right now it's very difficult for market participants to do complete kaliwaan, right? There will always be something that will happen first. The transfer of the security or the payment gets wired first. Uh, but you can actually design a smart contract such that one party puts the payment and then the other party puts in the commodity or the security. And then once the contract has validated that indeed ito yung price na napagkasunduan, it will perform the transfers directly. Right? So that's a piece of technology that can replace a lot of existing manpower in the financial services industry. Now, I'll talk a bit more about there are a lot of applications of the technology outside of finance, right? Like in real estate, identity. Eventually, if we have identity on the blockchain or on DLT, there's a lot of services that we can unlock, right? If, for example, the database that tracks our identity is the same database that's used for example, elections or figuring out who has a driver's license or not, um, or determining if someone is deceased or not, then all of these other services can rely on that database. So you might be in a position to eliminate voter fraud or insurance fraud or other types of fraud because you're all relying on an identity database that's impossible or virtually impossible to corrupt. But for this discussion, and I guess to keep things pretty short and focused, we'll focus on applications in finance, specifically in securities. All right. Now, kanina, Commissioner F actually also has a slide similar to this where he discusses um, how the current capital market infrastructure is set up. So if you've ever owned a share of stock, for example, a PLDT share, actually your name does not will most likely not appear on the transfer agent's records of PLDT, and that is because the financial market infrastructure has evolved such that we now rely on nominees. How did that happen? Well, before, as you know, most securities were in certificate form or paper form, right? If you want to sell that security, you physically go to the stock exchange, hire a broker, and then that broker will go around the exchange, look for the best price, and then sell it for you on your behalf. But as markets sped up, the need to facilitate settlements much faster and much more accurately um, drove the demand for these certificates to just be centralized somewhere by someone who will then just keep track of how many shares are owned by person A, B, C, and D. Now, here in the Philippine setting, we actually have depositories that fulfill this role. For the equities market, we have the Philippine Central Depository, or CPDTC, Philippine Depository and Trust Company. Now, what they do is they actually appear as the nominee sa records ng transfer agent or ng issuer. And in that, in the records of the depository, that's where the depository would then name who the custodians or the trustees are, or the brokers. And then in the records of the brokers and the custodians, you might see more brokers, more trustees. So suffice it to say that the nominee-based traditional infrastructure has created a lot of layers between the issuer and the actual beneficial owner. Is that a problem? Not. It hasn't been a problem really before, right? I think it was a substantial improvement to trading physical securities or physical certificates. But as the market becomes much bigger and much faster, we're starting to see the problems inherent to this nominee-based model. A lot of times when PDAX talks about the inefficiencies of a nominee-based infrastructure, people tend to think of efficiencies in the form of manual processes, right? Marami kasing papel, mabagal, different systems are being used, etc. Yes, I think if we had a, if we use, for example, if we used DLT to record ownership in terms of security tokens and digital asset wallets rather than records with a custodian, sub-custodian, and broker, we might have those efficiency gains. But we feel that the bigger benefit actually comes from expanding market access. Okay? What do I mean by that? What I mean is that because this nominee-based model relies on parties in the middle who need to profit from the transaction, we have a market failure, right? The guys in the middle do not have the economic incentive to service the entire archipelago because they might set up branches in small municipalities in the far-flung areas where they cannot get enough customers to support the branch. Then they just decide not to do it, right? Or because the processing required to onboard a customer is too tedious and too manual, then they don't accept clients with under 10,000 pesos in portfolio holdings, or 5,000 pesos. Or in some cases, in the cases of private banks, they don't accept clients under $1 million. Okay, so the problem there is the issuer has every incentive to access a wider market, right? Even if an investor only has 500 pesos to sell or 500 pesos to invest, the issuer would want to receive that funding, but because the intermediaries are not giving access to the issuer, uh, market failure is what happens. And historically, this has been a problem for a lot of developing economies, not just the Philippines. I think over the past decade, various efforts have been done to encourage wider adoption of investment products, but still the fact that as a whole or structurally, it's still too expensive to service everybody. Our market penetration is still in the low 1 or 2%. Um, Now, uh, later I'll discuss a bit about how security tokens or digital assets can change this. Um, but this is what a digital asset infrastructure looks like. Okay. Kanina, Commissioner F was talking about disintermediation being what can happen if we adopt digital assets. True, some roles will be disintermediated, but actually not all. For instance, there are roles that probably a centralized party is still in the best position to do. Okay, a good example would be onboarding a client, right? Um, Today, AML laws apply on people. Someone has to vet an incoming client, or someone has to run background checks. Someone has to approve it. So that one still needs to be done by an intermediary. Or someone has to advise the client on what to buy or what not to buy. Someone needs to perform a risk profile assessment on the client. So a lot of these roles will still stay. However, there are roles that probably will be automated, right? For example, if you're holding a bond, government bond that pays interest every quarter, 3%, let's say, uh, that obligation has actually been pre-agreed at issuance, right? So throughout the life of that instrument, you actually no longer need somebody to manually facilitate those payments or to manually make those payments. Um, and uh, and historically, our financial services institutions have had to raise their operating standards such that the reconciliation requirements are also very high today. Um, you have armies of analysts performing reconciliation work at many of these institutions. So what can be replaced? You can replace the record keeping system. You can replace uh, the paying agent or the facility agent who's in charge of paying the coupon interest on a fixed income security. You can also achieve real time kaliwaan. Okay? So this is what it can look like. Now, because these parties in the middle, okay, are built on smart contracts that actually cost very little to the entire value chain, you can now provide access to the smaller investors and the smaller issuers. Right now, if you're a small company and you want to raise, uh, let's say, 1 million pesos in capital, you actually will not be able to go to the financial market. It's not efficient for an investment bank to service you, and it's not efficient for the stock market to list your security. If you're an investor, particularly small investors, those who only have 2,000, 3,000 pesos, or even less than that to invest, right now they're unable to participate in the market. So by digitizing the intermediaries, you actually make the entire value chain much cheaper, and so you can allow for greater access at both sides of the market. All right. So, in a nutshell, that's what's happening in our securities industry. Not just ours, to be frank, but a lot of securities around the world, securities industries around the world. Except that our market is unique in that we're also suffering from market failures, right? That's why the penetration rate has been low. Whereas in a developed market like the US, these problems are not as limiting to the US. But they'll still probably have efficiency gains, not as much as a market like the Philippines. I'll share with you a bit about how digital assets are being created now. Okay. So 2017 there were a lot of ICOs, a lot of scam coins, etc. But the space has since cleaned up, right? And the tokens that you're seeing now gain a lot of traction or a lot of adoption are the ones that have actual underlying value. And that's probably the easiest digital asset to issue and to launch within the existing securities rules. Because it's as Commissioner F said, it's no different from how securities are being exchanged today. We're just substituting one form for another. What is Pax Gold? Okay? Pax Gold is a digital asset with a finite supply that you can inspect on the blockchain that corresponds to an equivalent amount of gold held in gold storage or held with a gold custodian. So let's say one Pax G corresponds to, for example, 1 ounce of gold. You can actually take your Pax G tokens and go to Paxos, the company, and redeem the actual physical gold. Right? So there's one-to-one backing between Pax G and the underlying gold. Now, why is this even revolutionary? A lot of markets today actually don't have a market for gold. In the US, definitely you can buy gold, right? You can buy gold strips or gold futures. You can also buy gold CFDs. But in many emerging markets, there's no gold market. In fact, in the Philippines, if the fortune teller tells you na, oh, you should buy gold because price is gonna go up, what you might do is buy jewelry, which is an impure form of exposure to gold because, you know, sometimes mas valuable ang bracelet, sometimes mas valuable ang kwentas, sometimes the purity of the gold is not consistent. So you encounter all these problems. But that's typically how we invest in gold today. Gold watches, gold jewelry. But if we just want pure gold exposure, we have to go to maybe an offshore broker to gain access. But with Pax Gold, we can transmit gold globally at a fraction of what it costs today. In fact, it's very difficult to to move gold around these days, right? You need armored trucks, you need security guards, and when you store gold, you need bunkers that are heavily guarded. But with PaxG, you can carry it with you digitally in your digital wallet and then transfer gold as easily as sending an instant message. Another similar a stable coin. So they're called stable coins. So another stable coin that's pretty popular is USDC, which is a dollar stable coin. What is that? It is a token. USDC is a token that's backed by the dollar 1:1. Who ensures the backing? Okay. Well, there's a cash custodian. One of the more, actually a few of the more prominent custodians in the U.S. Bank of New York Mellon, Northern Trust. They also maintain cash custody for some of these stable coins. So what do they do? This is a simplified explanation. What they do is they inspect the distributed ledger. How many USDCs are in circulation? Let's say it's 100 million. And then they check the vault. They check the vault to make sure that they have $100 million in cash as reserve backing the USDCs that are in circulation. Now, what does this do? Okay, some people might say, well, here, I mean, in the US, some people might say, I can transfer money using PayPal or Venmo. Why do I need USDC? Okay, well, in countries where access to the US dollar is restricted, USDC can actually be very useful. And also in parts of the world where financial services penetration is low, USDC can be a viable means of making cross-border payments. In fact, today, this is happening with Tether, which is another dollar stable coin. Historically, it's been very difficult to access the Chinese yuan or the RMB to make payments to suppliers in China, and that's because of the currency exchange restrictions. But if suppliers in China accept stable coins, then you can facilitate payments to suppliers in a matter of minutes, without any particular intermediary imposing fees or stopping the transaction altogether. Now, another advantage of dollar stable coins, and I can't emphasize this enough, is that it bridges the gap between the real economy and the decentralized economy. Okay, and I'm going to talk to you a bit about DeFi right after I talk about bonds.ph. We'll go to DeFi. With bonds.ph, really, what we're doing here is we're trying to make bonds more accessible to the average consumer or even to the unbanked. The cost of maintaining the registry of scriptless securities is currently shouldered by the Bureau of Treasury and the participating banks. Okay, so it's not open to just everyone. And in fact, the investment needed to put up an operation to conduct reconciliations, facilitate transactions on that registry is quite high, that it's impossible for them to economically make investment products available at denominations of 100 pesos or 500 pesos. So bonds.ph actually uses a distributed ledger as a record-keeping system. For bonds.ph, actually, we still maintain the ownership records of the underlying security in ROS, but we do have a blockchain-enabled component to replicate that, to kind of see how it works and learn from whatever we run in this pilot. So what's the difference in cost? Right now, it costs us about 5 to 10 pesos every day to maintain the ledger, which is massively cheaper than what you would expect a bank or a financial intermediary to pay. Okay? So hopefully, eventually, we can expand the use of that ledger to also take over the process of paying out coupons, or also the process of exchanging that particular security for cash. All right, so now let's move into DeFi. What is decentralized finance? Okay, you hear this a lot these days, no? More as buzzwords than anything else. But the opposite kasi is centralized finance, which is everything we know about finance today. We have banks, we have brokers, we have insurance companies, we have fintech companies. DeFi is financial services without the financial services intermediary. Okay? So what are examples of this today? Today, we actually have decentralized exchanges. PDAX is a centralized exchange. I'm a human being. We have a team of human beings processing transactions on a daily basis. But in a decentralized exchange, you don't have that. A buyer or a seller will go onto a decentralized exchange platform, place an order to, let's say, buy Bitcoin, and the let's say uh, the the person is gonna pay in Ether. uh, that contract is an open contract for somebody else to say, hey, all right, I will sell you X Bitcoin for your offer, right? And then the smart contract is triggered, parties agreed, and so the smart contract just executes the kaliwaan. Uh, is is this efficient? Um, well, you've eliminated all the intermediaries, yes, but that doesn't necessarily mean it's more efficient. Okay, there are problems with this in that uh, because transactions on the blockchain can be very slow. You also don't have a lot of uh, big institutions participating in decentralized markets. So if you don't have big institutions trading in these markets, there's no liquidity, right? So on a DEX, uh, you will suffer a massive liquidity discount. In many cases, pretty substantial liquidity discounts. And even then, you might not be able to buy as much as you want. There are also problems with regards to how compatible DEXs are with existing regulatory frameworks. Obviously, we cannot facilitate transactions if there's unmitigated money laundering risk, right? Someone has to make sure that AML rules are complied with, and someone has to monitor the transactions of the parties. So DEXs can be seen as incompatible with existing AML frameworks. Um, and because of that, banks, funds, or these high volume traders might not might not trade on DEXs until that's resolved. We also have decentralized money markets. Okay, so what's money markets? Well, these are products. These are borrowing and lending products. Okay, I think over the past quarter, we saw a spike in decentralized money markets activity, which I'll touch on a bit in this next slide. No? But suffice it to say, na, well, here it is in a nutshell. No, now people are holding a lot of cryptocurrencies. Okay, but these cryptocurrencies represent idle value, right? If I buy Bitcoin, that value there is locked in Bitcoin. It's not put to work, right? So what decentralized money markets are trying to do is they're trying to give you a rate of return on that cryptocurrency so that there's an opportunity cost to holding, and there's also a borrower's market that you can service. How do they do that today? Well, I'll explain later how Compound does it. But typically, because decentralized borrowers or lenders are unable to conduct credit risk on a potential borrower, a lot of these loans are collateralized by other cryptocurrencies. And then last, this one, I think JJ also touched on earlier. We also have decentralized insurance products. How does that work? Well, right now, the only thing that are insured are smart contract failures. Okay, I'll explain later what this interesting company, Nexus Mutual, actually does. All right. DAI. What is DAI? DAI is another US dollar stablecoin. However, unlike the USDC, the DAI does not have an underlying US dollar kept in reserve by a custodian. Instead, it works on a structure of collateralized obligations where whenever the price of Ether goes up or down, the contract becomes more attractive to a borrower or a lender, and it results in DAI always being pegged to the US dollar. Okay, so if you're interested to know how exactly that happens, you can visit the MakerDAO site, or you can download the DAI white paper, and it will explain to you how smart contracts using the price of Ethereum and other, you can actually collateralize other Ethereum-based tokens to help maintain the price of DAI to $1. Now, is this better than USDC? Well, it's more capital efficient, right? Because you're not actually locking up physical US dollars. But I guess the downside is that this is prone to, this is exposed to catastrophic risks in Ether, right? If Ether's price goes down, what happens is actually the collateralizations or the collateralized loans that facilitate the stability of DAI will trigger more selling, right? So Ether can actually plummet in value, and then you might see DAI go the same way. Compound, okay, that's another popular DeFi institution today. What they do is they actually offer crypto borrowing and lending. Okay, so like any money market, if I have cash, I can put it in a time deposit. I'll earn interest rates. If I have excess cash, I can lend it, or if I need cash, I can go to the money market and borrow cash. So in the same way, you can actually also go to Compound and borrow cryptocurrency. Okay, but because they can't really assess credit risk, you are able to borrow by staking in other cryptocurrencies. Let's say I want to borrow DAI, I will pledge Ether to borrow DAI. Okay, so a lot of these loans are over collateralized in such a way that these companies actually can earn pretty high returns off of just originating these loans. Now, there are so I guess so question number one is okay. Ang daming sinasabi nitong si Michelle. Is it useful? Okay? Pwede ba akong pumunta dyan and manghiram ng Ether so that I can spend it here in the Philippines for actual goods and services? Short answer is yes. Can you lend cryptocurrencies to Compound and earn an interest rate? The short answer is yes. However, here's the problem. The problem is, unlike traditional money markets, when you in traditional markets, when you lend money to an institution, that money is actually put to work in creating economic value. Okay, I lent money to BDO via a time deposit. DBO lent to this small business that uh, profits, pays BDO back with interest, and I get a portion of that interest. So there's underlying economic value being created. But in the case of DeFi loans and deposits, uh, the return or the yield that you're getting largely comes from financial market activity, right? Mispricings in the secondary market, right? Sometimes you see arbitrage, or sometimes it's also a case of mispriced markets, like or uh, hyped markets, right? Um, uh, it's happened in the past where issuers of tokens will hype so much the value of a particular token that a lot of people buy into the token, prices go up, and so they're able to borrow more against that particular currency. And then when the currency comes crashing down, loans are called, and then nothing gets repaid. So that's happened before. So it's very important to also pay attention to where the underlying economic value is being created. Uh, there are also risks now because DeFi is new. There are also inherent risks to the existing smart contracts. Some of them are not foolproof. In fact, Compound itself has suffered a compromise in its smart contract that resulted in, I think, the loss of 120 or 115 bitcoins. Okay, so basically, when you borrow money, you stake tokens into the smart contract. But if that's not secure, or there's a loophole in how it's designed, someone can attack that and actually take the cash or take the Bitcoin. Last that I'll discuss briefly is decentralized insurance. So Nexus Mutual is it's a great example. Actually, how does it work? Uh, uh, in the Nexus Mutual network, you have parties known as risk validators, right? So I'll explain what risk validators are, but they're a decentralized group of validators who get rewarded for assessing the outcome of a contract, right, or an insurance contract. So let's say I go to Nexus and then I pay a premium. Okay? I pay a premium to be covered for the performance of smart contract X. Okay, I don't like doesn't have to do anything magical. Okay, let's just say smart contract X is supposed to make payments every 30 days, for example. Okay, I go to Nexus Mutual and say, okay, can you insure me in case this smart contract actually fails, right? Now, fast forward, let's say 30 days from now, I don't get any payment from this smart contract. I go to Nexus Mutual and say, hey, I want to claim my compensation because the insurance, because the contract failed. What happens then is the validators will study the contract and see if indeed the intention of the smart contract was to pay something every 30 days. If that was the intent, then irrespective of how the smart contract executed it, the validators will say, I'm entitled to receive the insurance benefit. Now, how do they make sure that the risk validators act right, or really rule correctly on the insurance contract? If you're a risk validator and you go against the crowd, you will be penalized, right? You'll be penalized in terms of a cryptocurrency called NXM. If you side with the majority, or if your assessment is aligned with the majority, you get rewarded. So there's incentive to reading it in good faith. But what's the problem? The problem is it works for smart contracts because the risk validators can study the smart contract. They can assess how it's supposed to work and provide insurance coverage if it somehow fails. But can you do that for life insurance? Maybe not yet, right? Not yet. Can you do that for car insurance? Probably not yet. So the use case is still very, very small. But a lot of these technologies, right? To be honest, they're very promising. They're very, very promising. However, promise doesn't necessarily translate to actual rolling out of a particular product, which actually, in order for these products to be rolled out safely and actually viably, you need a market for it. People will need to see the value that it brings to the existing ecosystem and actually be in a position to say, hey, I want that applied to the RTDs, or I want this insurance smart contract protocol to be applied to life insurance or non-life insurance in the Philippines. And then there's also the regulatory framework. I keep saying this about fintech as opposed to other verticals in the tech space. In other verticals, technology is the leading indicator of what gets rolled out in the market, right? So same for Airbnb, Uber, Grab. Once the technology was there to match drivers or to match homeowners with tenants, boom, it rolled out, right? But in the financial services space, the leading indicator is actually what regulators are open to, right? So if there is no viable regulated environment for a lot of these innovations, many of them will not see the light of day, and sometimes for good reason. So I will stop there because definitely there's a lot of excitement in DeFi. It's still a very new and very risky space, particularly if you're thinking about lending cryptocurrencies to some of these DeFi projects. But the space is evolving very quickly.
All right, thank you, Michelle. Can we have Lars back? All right. We have a couple of questions here. Actually, madaming questions. The first question is, let me see. Actually, where is it? No, sorry, I have other questions. Somebody was asking about, is DeFi regulated now? Who's the regulator?
No, actually, there's no, well, the services under DeFi are actually regulated services. So if somebody wants to conduct these services, they would have to come under either the BSP or the SEC's rules. However, the problem with DeFi is the human being who's supposed to be the licensed entity might actually not be there. Yeah, at best you have the entity that writes the smart contract or the protocol, but after the protocol is deployed, any willing parties can just enter into those smart contracts, and nobody will be in a position to enforce or stop them. So that's definitely a tricky area.
Right. Actually, my sense here is that, you know, on the one hand, these DeFi, the way DeFi works is that we don't need them, or they don't need government regulation in order to offer their services. But the reality is that many of these providers want government regulation because it gives them sort of an imprimatur, no? It gives them a credibility to the market. So a lot of them are actually going for, and in fact, the ones that you mentioned, USDC and Paxos, those are actually regulated in New York. No, they have what they call a bit license in New
Right.
York. So these are regulated entities, and so that means that there's actually a government regulator that's overseeing whether or not the gold is actually there, and that the fiat is actually there behind the USDC. In the case of gold, I think in the Philippines, I'm not sure. Maybe we should find out. I think it's not lawful, or the buying and selling of gold is tightly regulated by the BSP. So the price of gold now in the global market is going up, and probably the only way for you to capture that is to buy a crypto like Pax Gold. There's a question here, maybe more for Attorney Lars. What about payment system operators? Aren't they required to register with the BSP? How will it be distinguished from a virtual currency or e-money?
Okay. Now, for operators of payment systems, correct, they have to register with the BSP. So it's not really a license. They just register, and that's done online. However, it's important to note that the OPS registration is not really meant to be an alternative to the EMI or the VC license. So the OPS rules have a very wide coverage. So they require all entities engaged in payment. So even if you're just a tech provider, you're supposed to get a registration. Now, whether you're an EMI or a VC exchange would depend on the functionalities available on your platform. So let's say you also issue electronic money and you allow the holders to transfer to one another and you allow them to withdraw. Then you're an OPS and you must get an EMI license. The same thing if you allow users to exchange crypto to crypto or crypto to fiat, fiat to crypto, then the VC regulations would apply. So it's an additional registration requirement, and it's not an alternative to VC and EMI.
Okay, I think so. Last question. There's two questions here. I'll just merge them together. Well, there was a side question actually on about whether digital assets have to be declared in your SALN. I think the answer is yes. You'd have to. I mean, if you own it and you're government official, you have to declare your asset. It would be considered an asset, I suppose. And they ask also, how much is one Bitcoin in Philippine peso? I believe Cassie answered that. Cassie says, as of 6 p.m., 518,512 pesos, 0.48. Okay, so I have two questions. I'll merge them now. So the question now is about implementation of blockchain technology. The first is in relation to land titles, whether that's a good idea. And the second question is, can you use blockchain for notarizing documents? And I think the question is the same in the sense that the question is really, is it a good idea to use blockchain so that we know that there's only sort of one copy of that notarized document or one copy of that title? And I'd like to hear from both of you.
Right. I think land titles are actually are an amazing use case for blockchain technology, right? Because it's so easy to dispute titles today. And if the record of ownership is on that distributed ledger, it's there forever, right? And then transfers are also recorded immutably. So there's no more misinterpretation or ambiguity with regards to who owns what. There are a lot of land title projects. So actually, I do know of one in the UAE, which was piloted by a company called Consensus. And the idea kasi of land ownership is that it's a bundle of sticks. Parang it's not just one right na I have this right to own, right? I'm not a lawyer, but I'm sure a lot of you are
No, that's
lawyers.
correct. That's correct. Very accurate.
Yeah, there's the right to earn from it, the right to actually live there, and you can also give easements, right? That you give a certain party the right to pass through your property.
Use it as collateral.
Exactly. So actually, you can design the land title as an instrument where even these individual, I'll call them baby rights, can be tracked on the blockchain. Na parang if I grant this person the right to live there in exchange for 30,000 pesos a month, that can become its own smart contract, right? And if I evict that person, it's very clear on the blockchain that actually we have a valid rental agreement. So there's so many benefits to having land titles on the blockchain. But the challenge, obviously, is that how do we get from uh, just having a nice idea and a nice product to actual mass adoption? I think
Right.
the other one that was mentioned was, what was that again? Sorry,
Notary,
DJ?
notarized docs,
Notary.
notarized documents.
Right. So there's also a project called Open Legal. I don't know if they were able to, maybe actually, now that I think of it, it's not Open Legal. I misspoke. But there is a project that uh, um, think of it as a DocuSign, but blockchain based. So the benefit of
Ah,
that,
yeah.
yeah,
Okay.
I just don't. Ano eh,
No,
the
we had
name,
we had a guest a few weeks ago,
Yeah.
Filipino. The name is si
Tuwala.
Jeffrey. Tuwala. Tiwala or Tuwala. So it's they're using blockchain for digital signatures.
Yeah, that's right. And this is what's nice. This is what's nice. You can actually, ano rin eh, you can actually customize the permissions on that particular blockchain-based notarized agreement. Na
Mm.
maybe only the parties who signed it have the right to view it, right? Or a third party may view it with the consent of both parties. Or no change can be made unless the transaction is signed by both parties. Or maybe a third party can be granted the right to view but not amend, right? So there's so many things you can do with it, and you don't need to worry that that hard copies are
Whether
kept.
whether that record is there.
Yeah, that's right.
Right. Okay. Maybe I don't know. Instead of Attorney Lars answering that question, I'll just ito na last question na. So, and it's a very good question I think for us to end on. The question is this, right? Wouldn't it be better to make government regulation voluntary, not mandatory, and then just test it out. If it doesn't work, it doesn't work, and if it works, it works. Anyway, if it fails, then regulation was unnecessary moving forward.
It's a great sentiment. So I'll siguro I'll say two things to that. No,
Yeah.
I've always been an advocate for responsible innovation. Right? These are exciting things, but these are also very dangerous things if not conducted or not executed correctly. And the laws are there to protect consumers. Um, now, there's also a very strong argument for sure to be made about well, these are initiatives that don't, we're not even sure if they will work, and if they do work, then it's valuable for the market. This is actually the approach taken by a lot of regulators around the world via a sandbox. So what a sandbox is the regulator will agree to allow a startup to operate without any rules yet, right? We'll just agree on certain principles. And then, yeah, go ahead. Go crazy. Test it out. If you get a lot of adoption or get a lot of traction that we agree on at the start, na you could get this traction, then let's talk about regulating your service. Because it also helps the regulator, right? They don't want to write rules for things that will never be used by the market, right? So at least it simplifies that process for them. And for the startup, a lot of the startups have finite lives, right? So they cannot wait for regulations to come this year or next quarter or even 2 years from now. So it helps both parties. It helps everyone to have sandbox.
Okay, Lars.
Hi. Just further to Nichelle's point, I think it's really about balance. It's a balancing act for government regulators. On one end, you want to be able to encourage innovation, be able to encourage companies to develop new ways of doing. But at the same time, they also need to protect the public, make sure financial institutions are not posing any harm to the public. So an approach that's being actually pushed for like by legal scholars is for regulators, especially in regulators that could affect the tech industry. Since we all know that technology moves faster than regulations or than the law, regulators should take a softer, like a soft touch approach. So they call it agency threats. Instead of pushing for laws, for amendments of laws and issuance of hard regulations, regulators are encouraged to come up with softer ways of regulating. So like, for example, issuing best practices, guidelines, as you said, coming up with sandbox rules, which in a way allows a certain portion of the industry to to innovate, play around, and at the same time, it allows regulators to learn about the technology and hopefully come up with better regulations.
All right, I think that's all the time we have. I don't want to extend. We've actually gone over time, but we're very happy with the questions. And actually, what you just said, the both of you, is really a, sort of a fitting way to end this this session of Digital Transformation Thursdays. I'd like to thank Commissioner F. I'd like to thank Michelle and Lars for being with us. Next week we have our session will be on telemedicine. I guess in closing, I just want to say that blockchain is really a major innovation that we'll see in our life. It will really change many things. DeFi. You could, it's a rabbit hole. You can keep on going down and deeper, and they're innovating at a breakneck speed. There was something recently, a coin that was just released, I think last week, called Sushi, and it's all crazy right now. It's early days. People are jumping on, and I guess with the pandemic, people have less things to do, and they have time in front of their computers, and they're investing. But it's something that I encourage all of you to investigate, and I think there are through innovation that we will see in this space and changes that we'll see in our lives. And on that note, I'd like to end this session of Digital Transformation Thursday. Thank you, and good afternoon.